There's growing speculation that a recession could be looming and rising uncertainty that Canada is being dragged into a prolonged trade war with the United States. Now the Bank of Canada has opted to hold its key interest rate at 2.75%. But is that the right move given what's at stake? Roger Collins joins us now with more. What can you tell us, Roger?
Manisa, the Bank of Canada is walking a tightrope, trying to stabilize the economy without making any sudden moves. Governor Tiff Macklem says the economy ended last year in a strong shape thanks to rate cuts that boosted household earning, spending, and growth. But since then, things have changed.
A lot has happened since our March decision 5 weeks ago, but the future is really no clearer. We still do not know what tariffs will be imposed, whether they'll be reduced or escalated, and how long all of this will last.
The seismic turn in U.S. trade policy, hiking tariffs on Canadian goods, has roiled markets, slowed investment, and put upward pressure on prices. And the uncertainty of it all has left the Bank of Canada holding its first key interest rate of the year.
Monetary policy cannot resolve trade uncertainty or offset the impacts of a trade war. What it can and must do is ensure that Canadians continue to have confidence in price stability.
The central bank says it's prepared to act if the data points sharply in either direction.
Given this uncertainty, point forecasts for economic growth and inflation are really of little use for anything.
Without a crystal ball to look into the future, no one can be sure of what's to come. But Canada's central bank is examining two of what it says are many possible outcomes.
In scenario one, we assume most of the new tariffs are negotiated away, but the process is unpredictable and businesses and households remain cautious. GDP growth in this scenario stalls in the second quarter, then expands only moderately. In scenario two, we assume a long-lasting trade war. The economic consequences are severe. Canada's GDP contracts in the second quarter, and the economy is in recession for a year. Growth gradually returns in 2026, but remains soft through 2027 as U.S. tariffs permanently reduce Canada's potential output and lower our standard of living. Inflation rises above 3% in mid-2026 as tariffs, countermeasures, and supply chain disruptions raise costs, pushing up many prices. Inflation then eases as weak demand limits ongoing inflationary pressures.
A similar sentiment from Macklem's American counterpart.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
I mean, Canadians are worried, and rightly so. We've seen closures of auto plants in Ontario and a whole slowing down in hiring in Canada as a result of the Trump tariffs and the general uncertainty in the world economy.
To make matters more confusing is the back and forth from the White House on its own trade policy.
We don't know what's coming next, and U.S. policy could well move back and forth before the situation is clearer.
While the bank's hands are tied on trade policy, it's watching key indicators closely: inflation, jobs, consumer spending, and how businesses react to the rising cost of imported goods.
I think what the Bank of Canada should have done is cut interest rates in a serious way to show that it will stimulate the economy, that there will be jobs there for the Canadians that need them, even if the rest of the economy, the rest of the global economy and the North American economy slow down or maybe even go into recession.
The next few months will be critical. If tensions ease, the economy could stabilize, but if not, a deeper downturn may be hard to avoid. Either way, this mostly comes down to the U.S. president and whatever he decides to do next.